Welcome back to Intelligent Investment Today, the podcast dedicated to cutting through the market noise, the fashionable narratives, and surface-level analysis to focus on what truly matters in investing. Long-term thinking, disciplined decision-making, and the intelligent deployment of capital, guided by the enduring principles of value investing, as laid down by Benjamin Graham. Today's episode begins with a small act of intellectual mischief, the sort that tends to irritate precisely because it challenges a deeply comfortable belief. So here goes. Warren Buffett, widely regarded as the greatest investor of the modern era, is not, at least primarily, a stock picker. This claim may sound absurd to many ears. After all, Buffett's name has become synonymous with patient stock selection, careful balance sheet analysis, and the philosophy of buying wonderful businesses and holding on to them forever. For decades, investors have studied his holdings as though they were sacred texts, hoping to reverse engineer his success by imitation. Yet this familiar image, reassuring though it may be, conceals something far more important. Buffett's true genius lies not in selecting individual stocks, but in the far less glamorous and far more powerful discipline of capital allocation. So if you've ever wondered if Buffett can still be considered a stock picker, or whether his style has moved on from that, then this episode is for you. So as always, sit back, strap in, and get ready to absorb another lesson in value investment, as inspired by Benjamin Graham. People are obsessed with stocks. They fixate on choosing them, ranking them, debating them, as though investing were a competitive sport in which the cleverest participant wins by spotting the right ticker symbol at exactly the right moment. Entire media industries exist to feed this obsession. Buy lists, sell lists, hot picks, bold predictions, all delivered with the breathless urgency of a horse race. It flatters the ego to believe that success comes down to clever selection. It also happens to be largely untrue. Buffett's mentor, Benjamin Graham, understood this better than most. Graham taught investors to think in terms of value rather than excitement, and he emphasised discipline over prediction. His tools, margin of safety, balance sheet analysis, sober appraisal, were designed not to generate thrills, but to prevent permanent loss of capital. And Buffett mastered these techniques early. During his partnership years, he applied them with exceptional rigour and achieved extraordinary results. At that stage of his career, he truly was an elite stock picker. But something important happened as his capital grew. Strategies that worked beautifully with small sums began to falter at scale. Opportunities capable of absorbing a few $100,000, or even a few million, could not absorb billions. The market became less forgiving, flexibility diminished, and competition increased. And this is the moment at which many investors stumble. But Buffett did something rarer. He adapted. The purchase of Berkshire Hathaway, often described accurately as a mistake, became the hinge on which his career turned. What Buffett ultimately acquired was not a textile business worth saving, but a corporate structure. A permanent pool of capital that could be retained, redeployed, and compounded without the constant interruption of client withdrawals or market fashion. Berkshire became a vehicle for long-term capital allocation. And once this structure was in place, Buffett ceased to operate like a conventional stock picker and became something closer to the steward of an internal capital market. Cash flowed in from operating businesses and, crucially, from insurance flow. His task was no longer to find clever ideas, but to decide where capital should go next. Sometimes it went into publicly traded equities. Sometimes it went into wholly owned operating businesses. Sometimes it went nowhere at all. And that final option, doing nothing and holding the cash, is often the hardest. Insurance deserves particular attention here because it remains one of Buffett's most misunderstood advantages. Insurance businesses generate float. Money collected today to pay claims tomorrow. And when managed conservatively, this float can be large and stable. It can be invested for long periods at little or no cost. Technically, float resembles leverage, but conceptually it is something far more subtle than that. Unlike borrowed money, insurance float doesn't come with an interest rate, and it does not force liquidation at the worst possible moment. Through businesses like Geico, Buffett gained access to enormous, durable capital with an unusually long time horizon. This altered not only what he could buy, but also how he could behave. He could afford to be early, he could afford to be wrong temporarily, he could afford, most heretically of all, to wait. This is where the romance of stock picking gives way to the reality of capital allocation. Choosing a good business at a fair price is difficult, but it is not unique. Many intelligent investors can do it. What very few can do is decide year after year, decade after decade, how to deploy ever-growing sums of capital without succumbing to fear, arrogance or boredom. Capital allocation is not a static skill. It is a continuous moral and intellectual test. Every dollar retained within Berkshire represents a decision. Should it be reinvested in an existing business, used to acquire a new one, held in reserve, or even returned to shareholders? Each choice carries opportunity costs and long-term consequences. One of Buffett's most unusual qualities is his refusal to equate activity with intelligence. In an industry that prizes motion, he has elevated inactivity into a virtue. The willingness to let cash accumulate when nothing attractive is available requires some degree of confidence, and it often invites criticism. It can look foolish in bull markets, and it demands emotional resilience. Yet this restraint becomes even more impressive when one considers the scale at which Buffett operates. Moving large sums of money is not like moving small ones. Markets notice, and prices respond. Despite this, Buffett has continued to allocate capital with remarkable simplicity. He prefers businesses that generate reliable cash flow, require little reinvention, and can deploy incremental capital at acceptable returns. When such businesses cannot absorb additional funds, then he looks elsewhere. If nowhere is suitable, then he waits. Berkshire Hathaway is often described as an old-fashioned conglomerate, but this label misses the point. It is closer to a private equity firm without the impatience, or a mutual fund without the redemptions. Buffett acquires businesses with the expectation of long-term ownership, not out of sentimentality, but because enduring ownership encourages thoughtful stewardship. He decentralises operations because it allows managers closest to the business to make decisions. Above all, he treats capital with respect. This approach reflects a deeper philosophy. Buffett does not treat capital as a scoreboard or a vanity metric. He treats it as a responsibility. So what does all this mean for the ordinary investor? One who does not control an insurance empire or has tens of billions of dollars to allocate? Well, more than might first appear. The lesson is not to mimic Buffett's purchases, for that way lies frustration. The lesson is to think like a capital allocator, even on a small scale. To ask not merely what to buy, but why capital should be committed at all. To consider the frictional costs of constant trading. To recognise that the most dangerous impulse in investing is the need to constantly feel clever. Most investors do not fail because they lack information. They fail because they lack discipline. They mistake excitement for opportunity and movement for mastery. Buffett's entire career stands as a rebuke to this mentality. It suggests that the real edge in investing lies not in brilliance, but in behaviour. Not in prediction, but in preparation. And not in constant action, but in patience. If one were forced to reduce Buffett's achievement to a single insight, it might be this. Stock picking can make you rich, but capital allocation determines whether you'll stay that way. Remove Buffett's analytical skill, and he would still be formidable. Remove his ability to allocate capital, and then he would merely be talented. Warren Buffett is often presented as a genial figure, dispensing folksy wisdom from the American heartland. This image is comforting, and perhaps deliberately cultivated. But beneath it lies a mind of extraordinary clarity and discipline. One that understands money not as something to admire or fear, but as a tool to be deployed rationally over time. He is not a magician, he is not a prophet. He is something both rarer and more useful. A master allocator of capital, in a world that persistently misallocates it. And that, rather than any individual stock he has ever owned, is why his record endures. And that is all for this edition of Intelligent Investment Today. I hope you've enjoyed exploring why capital allocation, rather than simple stock picking, lies at the heart of enduring investment success. I'm David Coombs, and this has been Intelligent Investment Today. Thanks for listening, and until next time, stay safe and happy investing.